Well, it's holiday season. And this is the time, of course, the best quarter for the hospitality sector, the hotel sector as well. How's demand shaping up? What are room rates like? And is it as strong like it has been for the last couple of years since COVID? We're joined by two hoteliers. We have Ashish Jakhanwala, Chairman, Managing Director and CEO at Samhi Hotels. Nikhil Sharma is Managing Director and Area Senior Vice President, South Asia at Radisson Hotels. Gentlemen, good morning. Great to have both of you here. Appreciate your time. Prashant, this side. Ashish, let me start with you. How is the third quarter panning out like? The big sugar rush post-COVID, has that lasted into this quarter as well? In terms of occupancies and room rates, is there any softening at all, or is it all up and up? Go on.
Hey, Prashant. So thank you for having me on the show. First of all, there's no sugar rush. COVID was bitter, and I'm glad that it's over. Whatever you're seeing in terms of performance is pretty stable. It's going to last us quite a few years. And this quarter is no different. So we've seen really strong performance continue this quarter. And it's been, as I said, something that we've seen coming in for a very long time.
So the third quarter, so far what you've seen, of course, we can't talk specific numbers, sort of big, much better than Q3 of last year?
Yeah, so we can see even for Samhi, at least because we run a large part of business hotel portfolio, we had seen even quarter one, quarter two grow very strong over last year, same time. And quarter three continues to maintain that trend, almost maintaining a double-digit revenue growth over last year for same-store hotels. I'm not talking about new inventory addition and all. So yeah, it remains pretty strong, actually.
All right. Hi, gentlemen. Good morning and good to see you. And you all seem to be in the best possible sector, and the best possible time. It's the most wonderful time of the year. Ashish, give us some numbers. I recall when we chatted last, you were talking about double-digit revenue growth for FY25. Is that well and truly on? Could that be, a surprise on the upside? And if you could quantify it, what could be the rough range? And I think you were suggesting that the adjusted margins were at around that 40% odd mark, and you were confident of holding out there. You reiterate that confidence?
Yeah, so I think there is no reasons to worry about maintaining a double-digit total revenue growth. And I'm talking same-store assets, and also the margins keep improving. This quarter and the next quarter, which is quarter three, quarter four, it's a rate.
Okay, all right. I think we have lost Ashish's audio, but I think we'll get back to it. The broad point was there's no big reason to worry. So that's good news. But in the meanwhile, let's get Nikhil as well into the conversation. Hi, Nikhil. Good to see you, Ben. Well, could you tell us what is your total portfolio like right now? How much of your portfolio comes in from tier 2, tier 3? And what is the kind of demand you've seen in this third quarter if you compare it with the previous ones?
Nigel, thanks for having us. Radisson Hotels in this country operates almost 130 hotels. We are in 78 cities as we speak. And I would say about 50% of our portfolio today is broadly between tier 1, tier 2, tier 3. And I would differentiate leisure as a segment by itself. So really, the Saputara, Lonavala are really leisure segments in themselves, and I wouldn't categorize them in tier 2, tier 3, tier 4. Of course, this is the best quarter for us as the industry, and at Radisson this year, we've seen average ADR go up by 10% in our like-for-like hotels, and for us, meetings and incentive, which is MICE, is a big contributor. And we've seen a 12% increase over last year.
That's good to hear. Sorry, Nikhil, overall, in terms of Q3 over Q3 of last year's, again, double-digit kind of growth?
Absolutely. And I know Ashish will hate me for saying this, but the best ever quarter, because Ashish has an analogy to it, and he should answer that. But this is the best November that we've seen at Radisson Hotels from a revenue perspective and from a growth perspective, and December is going to be better than November, and that's historically the best ever quarter for us. Which is true for the industry as well.
I completely agree. We have Puneet Chhatwal here. I remember speaking to him, and I remember him using that same phrase, best ever. And he's used that now for many quarters. So it is indeed been a super time. Ashish, you want to take that? Nikhil wanted to toss that to you.
So listen, my view is that the demand supply in the hotel sector will keep delivering best ever quarters for several years to come. It's like me saying I'm older than this year than I was last year. Growth is imminent. I think the way we interpret that is it's just the beginning. Hotel rates in India is still not. They have a huge headroom to grow. So I think we shouldn't be surprised about the fact that every year you will see a reasonable growth. Our long-term forecast shows anywhere between high single digits to early double digits sustainable growth rates in total revenues. So I'm not surprised. Obviously, I'm very pleased, but I'm not surprised that everybody will say this was my best ever quarter. Just as I would say I'm older this year than I was last year.
No, that's well put, Ashish. But we had so what is driving? Is this change in something? So I used the word sugar rush. You said there's no sugar rush, but something is different, right, compared to where we were in 2019 and what post 2020 has been like, and what people want to do. I mean, things change. I mean, consumer habits change. Quick commerce, for example, is an example, right? Very quickly, how fast consumer habits have changed. I don't know if that's a correct analogy, but do you agree? Is that, or you think this was anyway going to happen? What's your sense?
No, I think a large part of this was in any case going to happen because between 2008 to 18, the whole industry was getting built. And you saw some sort of a disturbance as any sector gets built. But 2017, 2018 onwards, most of the large cities had started stabilizing on new supply. And I can be very certain that as supply situation stabilizes, there was always enough demand for accommodation options or hotels or tourism in India. So I think it's very, very solid demand supply. We don't see supply catching up with demand in the next few years. And that's why, as I said, when demand and supply are so favorably stacked in favor of a sector, you would continue to see strong performance. There would always be disappointments about a quarter or two about the last year base, so on and so forth. But we've seen how last year people were worried about, you had G20, you had the World Cup. Everybody was worried that is that the peak and would you be able to deliver growth above that? But as I said, we have seen double-digit growth on same-store hotels in spite of kind of inheriting a very strong base last year. So I think it's solid growth. I think it's more like protein than sugar rush. It's building up your muscle. So it should last you a long time.
Ashish, easy to say you're on that side. I'm taking my family of four for Christmas out and, I think it's burning a lot of my fat, I think. So, just thinking about the kind of expenditure, but it's all for a good time and memories is what I understand is what makes it all worth it. But let's talk about business then, Ashish. Let's get a couple of numbers for you. Your debt reduction plans, well, they have been going according to plan. Could you tell us by the end of this fiscal, what should your debt number look like? And before we had the bit of that audio problem, you were going to tell us about the profitability aspect as well. Adjusted EBITDA margins, how does that go? So comment on both these two.
Yeah, so I think we have seen our stable portfolio cross 40% EBITDA margins. And I think over the next few quarters, you would see the whole business kind of getting towards that. So we're pretty happy with where the margins are. We think there is a reasonable headroom for growth as far as the margins are concerned. At a company level, we should report higher than 40% margins over the next few quarters. So that's one. I think in terms of leverage, we are very comfortable right now. As you know, we've been reducing leverage ever since we went public. We are generating free cash quarter-on-quarter basis. So we're doing two things, of course. One, that gets used towards reducing leverage. But even more important than that, as you know, we have invested some bit of a capital in growth projects. And most of our growth projects are very short capex to revenue cycle. So as we put capex, we expect the corresponding revenues to come over the next few quarters. And that will further help us deleverage the business because we're not really using any leverage for growth, So I think combination of free cash and then free cash being used towards both deleveraging and growth is really helping us kind of accelerate the whole deleveraging plans that we have for ourselves.
Okay, and I think the last recorded net debt number we have is 1,900 crores. As you said, you're throwing up a lot of free cash. Where is that number headed?
So, for now, it's around the same number because we used about 200 crores of free cash in October for our acquisition in Bangalore. So while our gross debt remains the same, our net debt slightly increased because of the utilization of cash for the Bangalore acquisition. But that acquisition will start throwing up both revenues and profits over the next few quarters. So eventually, it will then adjust our total net debt to EBITDA ratios.
And also, you were talking about this Navi Mumbai real estate that you all had, which you all could potentially set up, I think a 300, 350 hotel out there. Give us an update out there. Maharashtra elections are out of the way. What's the progress on that front?
No, so I think we had a very constructive dialogue with the administration before the elections got announced, and of course, then we went into a silent period. Now that the elections, are over, the new government is in place. We will kind of re-engage with MIDC. We believe that we have the right merits and the reputation to make that investment in the state. And as I said, I remain fairly excited about about Navi Mumbai as a future market. And you're right; it should potentially give us about 350 total inventory.
Okay, all right. Well, Nikhil, before we let you go, any plans of listing the company? Just look at the valuations. Ashish is smiling cheek to cheek. We have Mr. Puneet Chatwal as well. I met him a couple of weeks ago, and he said, "Nigel, I'll promise and I'll over-deliver. I'm so sure." Any plans in listing?
Nigel, not at the moment, but never say never. And just to your point on taking the family, you need to be more in touch with hoteliers because I can tell you we're seeing a 7 to 8% increase just in the holiday season, whether it's Kashmir or Goa. A lot of media reports that said Goa is down and out. It's not really down and out, at least not for December. It did see a dip through the year, but it's not seeing a dip anymore in this quarter.
I just had one last question to Ashish. Ashish, and you sort of you said best ever and protein, and I like that, protein, not sugar rush. As they say, right, what is worth doing is worth overdoing, and we've seen that in the real estate sector. Is supply going to overwhelm, or is it really far out? I mean, at least for the next few years, you don't see that.
So I think in the large markets where the current pace of supply is upwards of 9,000 rooms, you would see that supply is not able to catch up with demand because demand is definitely growing in that 8 to 12, 13% CAGR, right? So for supply to grow at that rate, you're talking about 700 rooms to 2,000 rooms opening every single year. I'm talking about different markets. So I think large markets which have a good supply base today, I feel very, very comforted by the fact that supply will not be able to catch up with demand growth. In some of the smaller markets, things can be a little bit more volatile over the years, where let's say the current base of inventory is 2,000 rooms or 3,000 rooms, and therefore 10% supply growth is, another 200 to 300 rooms really, So we've always said that we find greater comfort and margin of safety in larger office markets or larger hotel markets, where I'm quite confident that supply will find it really hard to catch up with demand, and definitely not in the next 3 to 5 years.
All right. So, I mean, a clean runway in that sense for hotel companies, and many years, at least a few years of double-digit revenue growth, top-line growth is what we should expect, as you put it. Both Ashish and Nikhil, thank you both for joining us here on CNBC TV18. It's a pleasure, and I should end this conversation by saying happy holidays. Thank you very much for being here. So that is a discussion on hospitality and hotels as we wrap up the year, Q3, the best of the year.